Hi, and welcome to the second, no, sorry, not second. How about the fifth objective for chapter 27? And in this particular objective, we're going to talk a little bit about how we would insure a portfolio or financial investing against losses. So let's go ahead and let me share my screen with you. And here we are. Okay, there we are. Okay, so we're going to take a look at the insurance of stocks. And one way we do that is through diversification. So diversification basically says, let's take the amount of money that you would want to invest and then break that into many different industries in different sectors, maybe even in different countries. So if you have, say, $10,000 to invest, if you put all of that into, say, CSX stock, because this is what my uncle did, and that's all he purchased. And the minute that I became the trust executor, I took that money and diversified it into many different types of stocks. So I kept the CSX because that would be my transportation industry kind of thing. I also then went into small cap funds, and that's a mutual fund. I did some in large cap, which is also a mutual fund, and then did some in electricity, and the other one I went into was foreign. Okay, so again, the idea here is the original, when my uncle had that, oops, sorry. When my uncle had it, he was really susceptible to two types of risk. And the first type of risk is firm-specific risk. So this is susceptible to firm and market. As I diversified away from that, okay, now I'm taking that same amount of money, but diversifying into several different funds, what I'm doing is decreasing the firm risk, but market risk will always remain because the market is the market, okay? Now, what we do is in finance, we take a look at the risk. We call this beta. And depending on where you're at in your life and your age, background, many different things, even where you live, can take a look at each person's individual propensity for risk. If you're a younger person, you have more time to earn, so you tend to have a higher beta risk than perhaps myself. So we measure these by standard deviation. This is one reason why you take statistics. And so what we look at are the standard deviations. So the higher the standard deviation, meaning the greater the deviation from the mean, if we use a traditional bell curve, this would be 0. And then we have +1 standard deviations, 2, 3, and 4. Now, as we move outward from the mean to these higher standard deviations, the risk of that particular portfolio will increase. Here's an example of kind of the number of stocks in a portfolio. Notice if we have one stock in a portfolio, meaning the number of stocks that you earn, you have a lot more risk than if you start to diversify, increase the number of stocks in the portfolio. Notice that you can reduce the firm-specific risk, but market risk will always remain. Now, there are some things that finance people do to get rid of market risk, and that might be stock options, some different things, and you'll learn about those when you take your finance class. So what should you take away? Take away that we can diversify away firm-specific risk, okay? We cannot get rid of market risk, okay? So diversify away the firm-specific, but we're always, and that's consistent in all stocks. Okay, so for example, Corona would have devastated some of the industries, and if you were only invested in that, then you might have seen a really low return. Market risk affected the overall, market. So when the overall market goes down, then that goes down. Now see how you can get rid of the firm specific, but you can never get rid of market. Okay, so here's examples of some assets. The trade-off, the more a person puts into stocks, the greater the risk and the greater the return. So that's that risk-return trade-off that we've discussed before. And one thing I said, and it's really important to note and share with friends, neighbors, whomever will listen, that the higher the risk, the higher the return. Now, what a lot of people think is you can guarantee me a really high return, and you're telling me it's riskless. That's incorrect. That can't happen. Okay. And that's how a lot of people get suckered into very bad schemes, some of them illegal, Ponzi schemes, and so on. All right. So here again is when we take a look at investing in stocks and the average rate of return, but the average standard deviation or risk increases, right? So if you have no stocks, you could earn 3%. If you have 100% stocks, you might be able to earn, 7%. But the thing we know is the higher the risk, the higher the return. And for a lot of new investors, I say, hey, the higher the return, the higher the risk. And you can't get around that one. Okay. The next thing we want to look at is use the present value formula to take a look at asset valuation. So there are 3 asset classes that we're going to talk about. If the value of the stock is greater than the stock price, okay, then we're going to say that it is undervalued. If the price in the market is greater than the value, then it's overvalued. It's fair valued if they're equal to each other. Now, who uses the fundamental analysis? Well, probably the most famous person I can think of is Warren Buffett. Warren Buffett scours the market for undervalued stocks, okay? Where he believes the value of the share is greater than the price, he will scoop up the shares. But as he does so, as his action of buying, what will happen is it's going to drive up the stock price, particularly if you're Warren Buffett, and the price goes up. So sometimes it may not necessarily be undervalued, but his moving of the market will make it then where it will become fair valued or even overvalued. And that's at the point at which he would sell it on. Now, some people use a different strategy when they are doing financial investing, and they might search for overvalued stocks. In an overvalued stock situation, you want to what they call short the stock. And it sounds like we only buy low, sell high, but that's not true in shorting stock. What we actually do is rent shares. I know that seems weird, but we buy them, we rent them at a high price, okay, when the stock price is high. Then we sell them when the stock price is low. And what essentially we're doing, because we didn't own it, we just rented it, and we have to pay our option contracts to be able to do that, we make a difference between the high and low price. Okay, that's options. And again, you'll get into that if you take a finance or investing course. Okay, so let's take a look at how this would work. You will be able, you want to buy a share of AT&T stock today. You'll be able to sell it in 3 years for $30. You'll receive $1 dividend at the end of each of those 3 years. If the prevailing interest rate is 10%, what is the value of the share of AT&T today? Okay, so let's grab some information here. So we're going to sell it in 3 years for $30. So I'm going to put the sale price, amount you receive, $30 in 3 years. Okay, then we're going to receive $1 dividend at the end of each of those years. So we're going to receive $1. When you're going to receive it? The end of year 1, $1, the end of year 2, $1 at the end of year 3. Now, if you're thinking about this and go, wow, how do we figure out the value? Yeah, remember back to our second objective where we said the present value is equal to the future value times 1 plus the interest rate to the negative nth power. Okay, so that's the formula I'm going to use here. So essentially, if I take $1 and I want to bring that back to the present, so I'm going to say $1 times 1 plus the interest rate, and that was 10%, to the negative first power. And so I'm going to grab my financial calculator here and do that very quickly, hopefully. 1.10. I'm going to hit my exponent key, put in a 1 negative, and my factor is going to be 0.991, and I'm going to multiply that by $1, which gives me roughly 91 cents. Okay, not a whole lot there. All right, I'm going to do the same thing for year 2, but now I have $1. I'm going to say 1 plus the interest rate, 0.10, to the negative 2 power, because it's 2 years that I'm going to get that. 1.10 y to the x 2 negative. So that gives me a factor of 0.8264 times $1. So that is roughly 83 cents. Okay, now I'm going to do the same thing with year 3. Think about what that would look like. In year 3, I got a factor of, and hopefully you did too, 0.7513 and 0.75, 75 cents. Okay, the last one, because we're going to get that $30 we expect when we sell this. So now we're going to take $30 and we're going to take it 1 plus the interest rate to the negative third. And so that's the same factor of 0.7513. Multiply that by 30. And it should be $22.54. So I'm going to add all those up. 22.54 plus 0.75 plus 0.83 plus 0.91, $25.03. So is AT&T stock fair valued, overvalued, or undervalued? So let's jump over to the internet, and take a look at what that would be. So let me find, there's a tab that's open. I'll go ahead and share that. Sorry, I got lots of junk open here. So let me go into my new tab. I'm just going to go to CNBC, okay, just because it's easy to get to stock symbols from CNBC. I don't have a preference or anything like that. So let me do this. And hopefully I'm going to stop the share for just a minute because I'm not sure you can see my screen. So let me share my screen with you. And now let me go to CNBC. Hopefully you can see it. I think you can. Okay, so what I'm going to do up here is search stock quotes, and I'm just going to put AT&T, T. Oh, here, it's just T. Okay, it's $30.16 today. So is it overvalued, undervalued, or fair valued? That's kind of how it's been performing. This is why I like CNBC stock ticket prices, because hey, we had a really low hit on, this would have been the market close on Friday because I'm recording this on a Saturday, but you get a nice little, markets and thing to get year to date, 6 months, 3 months, and so on. It also gives you lots of stats down here, the earnings per share, the price to earnings ratio, return on equity, debt to equity ratio. Wow, that's large, 92.40%. That means they have a lot of debt based upon the number of shares outstanding. Okay, so I'm going to go ahead, stop that share for just a moment, and now I'm going to share the PowerPoint. And remember, it's $30.16. So is it fair valued, overvalued, or undervalued? And if you answered that it is overvalued, you're right, because the reason it is, what did I do with my pen? The reason it is overvalued, there we are, is because the price in the market So the price of $30.16 is greater than the 25.03. So it is overvalued. In this case, you might short the stock and then try to make a gain on the loss that AT&T should have. So let me just erase my slide here, and here's our answer. So we have 22.54, 25.03, and we ended up with 30.16. So it is again over valued at the current time. Okay, so fundamental analysis to pick stocks. So how do you pick good stocks? Great question. If we all were good at this, we all wouldn't be working. I do have a master's in finance. I hire somebody to do this, okay? There's a great quote. It says, I pretend I don't know what I'm doing, and I hire people who can. So when you take a look at this, I hire somebody because this is a full-time job, moving money in and moving money out. So again, here's some examples of mutual funds. Now, mutual funds, again, are slivers of the index that it's based upon. So we all probably can't go out and buy all of the tech sector, but we could buy a mutual fund that represents the tech sector in some certain proportions. So if you'd like, you can do this hyperlink. And again, I'm not telling you that you should invest in any of this. I'm not giving you any kind of investing advice. If you listen to a lot of the news I do, and so, you know, investing involves substantial risk. So there's my big disclaimer. And you also get what you pay for. Okay, so I'm giving you free advice, well, tuition advice. So my point is, this is just to show you what some mutual funds are. Okay, so that is the end of this objective. And in our next objective, we're going to talk about the efficient market hypothesis. And is the efficient market hypothesis still true? Why do economists still call it a hypothesis? And what exactly does that mean? And what does it mean to us? Thanks for your time and attention.